Hey, Courtney Smith here, and I want to talk to you about what happened today in the Treasury notes. We've had a complete capitulation here. As you can see by the chart, we've been in a bear market now for about 6 weeks, counting from the high of the move. But we really accelerated on Monday and Tuesday early this week. We collapsed. We saw some stability yesterday, but today we are ending the market down on the lows, which suggests that we're going to see some more carry through for tomorrow. This is an important consideration for a number of reasons. First of all, I believe that being short Treasury notes or bunds or gilts or any long interest rate instrument is going to be one of the greatest short sales of the next 5 years. But it's not going to happen quickly, and it's not going to happen dramatically. It's going to struggle, but we're going to be able to be making money on the short side of bonds for the next 5 years. The reason is because we have had a bubble caused by the massive easing by the Fed, which has hammered interest rates lower, combined with the worst recession since the Great Depression. And those two things combined have caused interest rates, short-term interest rates and long-term interest rates, to be much, much lower than they would be if there was a free market in interest rates. Now, what's going to happen is, and what triggered this, is signs that the economy in the United States is doing better than it had been previously thought. Today's numbers on the trade deficit were the triggering factor for today, but other economic indicators have shown that the economy is seeing some signs of strength. The reality is that the economy will struggle along at maybe a 2.5–3% rate, which is not bad actually. But that's only if the tax compromise passes. And the reason I say that is because the cut in the Social Security payroll tax from 6 to 4% will add 1% to GDP by itself. And it's that factor that I believe is the most important factor that's causing this drop in the Treasury notes. In addition, I believe that the fact that the Bush tax cuts will be kept in place also means that the economy is going to grow stronger now that there's certainty and now that there are low taxes. Low taxes always increase the value of income in society. So we will see more income be developed in society as a result of these continuations of the tax cuts, even though it's only for 2 years. Now, those are the reasons why we're seeing the Treasury notes sell off. We need to be looking for every excuse to be short this market. I'm already short this market, but this is going to be one of the key trades going forward. Stock investors, don't worry. These rising interest rates are actually going to be bullish for the stock market. What we're seeing is an increase in the yield curve so that it's becoming more positive. In other words, interest rates are going up while short-term interest rates are going down. So the spread between short and long-term interest rates is widening. That's going to cause the stock market to go up because a positive yield curve is an excellent predictor of where the stock market will be 1 year from now. So take a look at this. We're bullish on stocks. We're bearish on bonds. That's it for today. We'll talk to you on the next video.